In the bustling world of startup finance, a revolutionary approach is reshaping how young companies secure the funds they need to soar. Imagine, if you will, a landscape where traditional funding routes merge with the sophisticated mechanisms of financial derivatives. Today, we're diving deep into this innovative fusion, exploring how derivatives are not just tools for hedging or speculation, but vital instruments for funding. Firstly, consider the power of hedging future revenue streams. Startups, especially those with revenues anticipated from long-term contracts, can harness forward contracts to secure these future cash flows. This strategy doesn't just lock in revenue, it crafts a financial forecast that's as predictable as sunrise, making these ventures tremendously appealing to investors and lenders. Next, let's talk about convertible bonds. These are not your average bonds. They act as a bridge between debt and equity, offering the holders the option to convert their investment into stock at future dates. For startups, this means attracting capital without the immediate weight of interest payments, while providing investors a chance to share in the success if the business thrives. Then there are warrants and options. When startups integrate these into funding rounds, they gift investors with the right to buy shares at a preset price. This strategy is a double-edged sword. It motivates investment and simultaneously delays the dilution of existing equity, keeping current stakeholders happy. Moving on to equity swaps, startups can swap out the rollercoaster ride of equity returns for more stable cash flows. This transformation can significantly smooth out financial volatility, presenting the business as a safer bet to potential lenders. Risk management plays a crucial role as well. By leveraging derivatives to shield against various risks, think interest rate hikes, currency fluctuations, or swinging commodity prices, startups can polish their risk profiles. This isn't just prudent management, it's a strategy that can unlock more favorable loan terms. Strategic partnerships often come with derivative terms. Imagine a startup and a supplier locking in material prices via a forward contract. This not only stabilizes costs, but also enhances predictability in financial planning, a cornerstone for sustained growth. Creating synthetic positions is another intriguing strategy. Startups might use a mix of derivatives to mimic other financial instruments, like synthetic equity, which provides capital infusion without an immediate dilution of ownership stakes. Lastly, collar agreements are particularly noteworthy. These allow startup founders to protect the value of their equity stakes by limiting downside risks while also capping the upside potential. This stability can be a game changer, providing founders the confidence to invest more boldly in their ventures. In summary, by integrating derivatives into their funding strategies, startups not only manage risks and stabilize cash flows, but also enhance their appeal to both investors and lenders. This isn't merely financial innovation, it's a strategic evolution, tailored for the dynamic world of startups. As always, the key to success lies in collaborating with financial experts to tailor these strategies to the specific needs and risk appetites of the business. This exploration into the nexus of derivatives and startup funding reveals not just opportunities, but also a blueprint for financial resilience and growth. A world where foresight, innovation and strategic financing converge to redefine the boundaries of possible.